Our chapter 2, the principles of capital budgeting, concerns one of the most important financial decisions that the company makes, which is the investment decision. So when we say capital budgeting, the word capital implies long term. So in this chapter, we will talk about the long-term investments made by the company, and to be able to make these long-term investments, the company needs long-term funds to use the equity, the long-term debt, bonds, etc., to finance these capital, if you want, assets, long-term assets, fungible assets. So capital budgeting is simply the allocation of funds, long-term funds, to long-lived capital projects. So the capital budgeting, simply we try to see and to understand the process of identifying and analyzing the different projects that we have to decide which project to include in our investment budget. So here, first of all, we need to know, to understand how to make the classification of the investments. The investments can be classified according to many criteria. They could be classified according to their objective. They can be classified according to the degree of homogeneity of the projects, according, for example, to the rhythm of cash inflows and outflows in relation with the project. So we will see here, for example, if we make a classification according to their objective, we can distinguish replacement projects, simply by which is the fact that the company replaces existing assets with similar assets. An expansion project which simply can be used to increase the size of the business, the productivity of the business. Or we can, for example, make new products and services. Here in this case, we try to introduce a new project, a new service. We have also regulatory safety and environment projects, which are mandatory projects in this case, or other projects like research and development, etc. Classification can be also made according to the degree of homogeneity and the investments, and this will allow us to set projects according to the fact that they are mutually exclusive or independent. The selection will be different according to the degree of homogeneity of projects. What do we mean by mutually exclusive projects? Mutually exclusive investments serve the same purpose. It means that the projects compete with each other. They serve the same purpose. It means that if we accept one project, if we select one project, we have to reject all the other projects. We call these projects mutually exclusive projects. For example, a company may either use a more labor-intensive semi-automatic machine to produce the products, or employ a more capital-intensive, highly automatic machine for the production. So when we choose the semi-automatic machine, we have to exclude the other alternative, which is the use of a highly automatic machine. According to the cash inflows, cash outflows, to the costs of each alternative, we have to select only one alternative, because these two projects serve the same purpose. We can't accept both of them. Projects could be independent. In this case, they serve different purposes and do not compete with each other. In this case, we can accept all the projects that are profitable, of course, if we have the available funds to do all these projects. For example, a heavy engineering company may be considering expansion of its plant capacity to manufacture additional excavators and an addition of a new production facility to manufacture a new product like commercial vehicles. The two projects are independent. We can undertake both if we have, of course, the required funds, the available resources to invest in both of them, because the two projects do not compete with each other. If the two projects are profitable and we have enough funds to finance them, we can choose or keep both. Projects can be contingent. Contingent projects are dependent projects. In this case, the choice of one investment necessitates undertaking one or more other investments. For example, if a company decides to build a factory in a remote backward area, in addition to building the factory, the company needs to make other investments in houses, maybe roads, hospitals, and many more for employees to attract the workforce. So the total cost of this project is not only the cost of building the factory, is also the cost of the annexes that we have to build. We have to take into consideration all the costs in this linked, if you want, to this investment project. But mainly the criterion that we will use when we decide which project or which projects to accept and to reject depends on whether the projects are independent. When projects are independent, as I said, we can choose many projects at the same time because they do not compete with each other. But when projects are mutually exclusive, we have to select only one project, the best one according to the criteria that we will see later. Classification can be also made according to the rhythm of cash inflows and cash outflows. In this case, we have conventional cash flow patterns. The conventional cash flow patterns means that the negative cash flows represent an investment flow. When we say cash flow, it means a flow of cash, a flow of money that will go outside the company, an investment, negative cash flow, or inside the company, it's a cash inflow. If all the cash outflows, the negative cash flows, precede the positive cash flows, we call this cash flow pattern a conventional or normal cash flow stream. We invest, then we receive cash. So in this case, we have only one change in the signs of the cash flows, from negative to positive. We have only one change in the signs of the cash flow. If we have more than one change in the signs of the cash flow, it means that not all the negative cash flows precede the positive ones. In this case, we call it a non-conventional or non-normal cash flow pattern. For example, we can invest today. This investment will generate positive cash flows in the future. Then we need to make a disinvestment. We have to invest another amount to disaster, for example, the equipment or the factory we built, etc. Or we can invest today, getting a positive cash flow, then we make another investment that will generate another sequence of positive cash flows. Here we have more than one change in the signs of the cash flow. From negative to positive, we have one change in the signs, then another change in the sign from positive to negative. We had two changes in the sign. Here we have more than two changes, from negative to positive, one change, from positive to negative, second change, from negative to positive, third change in the sign. what will this, how this will affect our choice? This will affect mathematically and economically the criteria that we will use later to say whether to measure, for example, the profitability of a project, the rate of return, the unknown rate of return linked to a project. When we have a non-normal cash flow stream, mathematically we can find more than one rate of return for a project, and this will represent for us a challenge later how to solve this problem. We will see how to do this later. Huh? But what are the stages of the investment process? The capital budgeting process requires first analyzing many ideas, will generate different ideas. Then we will analyze these ideas, how to analyze the different ideas, the individual proposals, by collecting the information linked to this idea and measuring the profitability of each individual proposal. Then we make planning for the capital budget. We analyze the fit of the proposed project with the company's strategy. Once we implement and we choose the project or the projects, we need to make a control, if you want, a monitoring, a post-auditing, by comparing the expected and the realized results, and to explain why we have deviations and try to correct the deviations. These are the four steps mainly. Now, once we select a project or to analyze, we need to perform this process. First, we need to estimate the project cash flows. When we say cash flows, we mean the cash outflows, the investment flows, what are the costs that the company must pay, if you want, in relation with this particular project. Then what are the cash flows that this project will generate in the future? We call them the inflows. So first thing to do is to estimate accurately the inflows and the outflows in relation with the project. Then, according to these inflows and outflows, we compute some investment criteria. We will see the different investment criteria, the meaning, the difference between them, how to use them to make the decision in the third phase. We decide whether to retain or not the project according to the computed investment criteria made in the during the second phase of the process. Here, in the calculation and the estimation of the different cash flows to be able to make the better choice later, we need to use basic principles. These principles are, first, all our decisions must be made on the basis of cash flows, not accounting revenues. And we will see the difference between the accounting revenues, like the earnings, the net income, earnings before interest and taxes. You learn this in financial accounting, and the cash flow. In finance, we use the cash flows. The calculation of the cash flow is based on accounting revenues, but we will see why it is important in finance. When we assess the profitability of a project, we need to compute, to calculate cash flows, to base our decision on cash flows, not accounting revenues. Then, once we compute these cash flows, we need to take into consideration, as we said in our introductory chapter, time value of money, we need to take into consideration the timing of the different cash flows, because we can't compare a cash flow that we will pay today with a cash flow that we will receive 10 years from now. We need to take into consideration the time value of money, and the use of the time value of money is based on the discount rate that we will see later, that we will use to compute the value of all the cash flows at the same time, to be able to compare them. Cash flows must be incremental. It means that we need to compute the cash flow in relation with the particular project, what this project will add to the available cash flows of the company. So we will compare the cash flows with and without the new project. This is the meaning of incremental. We will see it later. We will explain it more later. Cash flows are on the after-tax basis, of course, because in the calculation of the available cash or the cash generated by a project, we have to take into consideration the cash that we need to pay to the government as taxes, etc. So all the cash computed are after-tax cash. Financing costs are ignored here. When we assess the cash flow in relation with the project, we need to separate, if you want, the investment decision, this investment decision, from the financing decision, from the cost of the money used to finance this project. The cost of the money used to finance this project will be used later when we take into consideration the timing of the cash flow. To compute the value of a cash flow today, we will discount it. The future cash flow will be discounted. The discount rate will reflect the cost of the money used to finance the project. We will explain this later. We will see this later. So these are the basic principles. As I said, decisions are made on cash flows. Timing must be taken into consideration. Cash flows are incremental. Cash flows are on an after-tax basis, and financing costs are ignored. First step of the capital budgeting process is the assessment of the project cash flows. In this section, we will see how to estimate the cash flows in the case of an expansion project, of a new project, and how to estimate the cash flows in relation with a project when this project is a replacement project. We have an existing situation with an old project, and we want to see whether it is better to replace the old project with a new one. How to estimate the cash flows in both cases. So first, what are the costs to include and to exclude from our calculation, from our assessment? The cash flows that should be included in a capital budgeting analysis are those that will only occur if the project is accepted. This is why we call them the incremental cash flows. To know whether to include or no a particular cost or a particular revenue due to the acceptance of a project, we need to ask ourselves, will this cost or will this cash flow occur only if we accept the project or no? If the answer is yes, this cash flow will occur only if we accept the project. This cash flow could be a cost or a revenue. If the answer is yes, we should include this cash flow in our analysis, because this cash flow is an incremental cash flow, is linked to this particular project. This project, for example, will increase the sales of the company by $20 million, or the implementation of this project will require an additional investment of $20 million. The $20 million is an incremental cash flow that we need to take into consideration. If the answer is no, this cash flow will occur if we accept or if we do not accept the project. In this case, we do not include this cash flow in our analysis because it will occur anyway. If the answer is part of course, we should include the part that occurs because of the particular. For example, if currently the firm generates $100 million in sales annually, by undertaking an expansion project, the firm can generate $120 million of sales. What is the cash that we have to take into consideration in our analysis? Should we incorporate 100 million or 120? Of course, we will not take into consideration the totality of the 100 million sales, because from the $100 million sales, 100 million are already generated by the old projects of the company. So we have to take into consideration only $20 million in our analysis. This is the incremental cash flow generated by this new project. Here we have some important capital budgeting concepts that we need to master, if you want, that will help us in the estimation, if you want, of the different costs and the different cash flows in relation with a project. First of all, the sunk cost. The sunk cost is simply a cost that has already occurred. So if the cost has already occurred, it cannot be part of the incremental cash flow. For example, suppose that in your project you will use a building that would otherwise be idle. It means that the cost of the building is already will be supported by the company, regardless to the fact that the company will accept or reject this new project. So here we talk about a sunk cost. An opportunity cost. The opportunity cost is what would be earned on the next best use of the assets. For example, suppose that the building that the company will use for the new project could otherwise be rented to another business or sold to another business. In this case, we have an opportunity cost, what we could earn if we ran, if you want, this building, will represent for the company an opportunity cost that we have to take into consideration in the estimation of the cash flows. An incremental cash flow, as I explained before, is the difference in the company's cash flows with and without the project. For example, the case of the sales that we saw previously. An externality now. An externality is the effect that the investment project, the new project, has on something else. For example, on the existing sales of the company, or for example, outside the company on the employment of the town, for example. One example of externality is the cannibalization, which is a negative externality, in which the investments, the new investment, reduces cash flows, the sales, for example, of the existing company projects. So we have to take into consideration these different effects when we estimate the cash flows in relation with a particular project that we are analyzing. Let's take some basic examples to better understand the difference between sunk costs and opportunity costs. Suppose the company bought some production equipment 2 years ago for $100,000, but due to technological advances, current equipment that costs only $25,000 can do the same job faster and cheaper. The old equipment bought 2 years ago for $100,000 can be sold for parts yielding $8,000. What should be included in the capital budgeting proposal for the replacement project? What will be the cost of replacing the old machine by the new one to that? Simply, since the old machine can be sold at $8,000, and we will suppose that the $8,000 will represent the net salvage value. It means what is the net amount that we will receive if we buy the old machine today at at $8,000. We will receive the totality of the amount. We suppose that we will receive $8,000 today. We have no other costs to pay. And we have to buy the new machine at $25,000. So the replacement will be, the cost will be simply 25 minus 8. And the $100,000 paid 2 years ago are already taken into consideration in the estimation two years ago when we computed, when we first implemented this product. So we have to take into consideration only the costs today. The $100,000 is a sunk cost for the company. We should ignore it in our analysis today. Installation of the new equipment is expected to use 27 man-hours of labor. Due to a current slowdown in our activity, this labor can be provided without affecting the production of the company. No layoffs are being considered at this time. Note that the direct labor costs are $22 per hour, but are costed at $50 per hour with overhead costs. How much should this add to the cost of the replacement project? To install the new equipment, we need 75 man-hours of labor, but the company is going to incur the labor costs whether or not it goes ahead with the project. So the cost, or the labor cost, will not be directly related to the installation of the new equipment. So it's a sunk cost for the company because it will be paid whether or not the company will use this new equipment. It represents for the company a sunk cost. The third example, the replacement project will require some support machinery to operate at peak efficiency. The company makes this machinery at one of its other factories. The machinery costs $12,000 to produce and sells for $16,000. At the moment the company has more orders than it can fill. How much should be charged in the proposal? Here, of course, since the company at the moment has more orders than it can fill, and since the machinery can be sold at $16,000, the $16,000 will represent an opportunity cost for the company. So this replacement project will have an opportunity cost of $16,000 that we need to take into consideration. But if the company had slack production capacity, then we will use the cost to produce this machinery, not the cell value of 16,000. The last example, the company owns a vacant lot of land that originally cost $100,000. The current market value of this land is $600,000. What should be included in a capital budget for a project that uses this land? Should we use the original cost, 100, or the current market value of the land? Of course, since we can sell this land today at a market price equal to $600,000, this will represent for the company an opportunity cost. Of course, and this opportunity cost is taken into consideration in its totality. And if the sale of this land will generate for the company other costs, for example, commissions or taxes to be paid on the capital gain, we need to subtract the taxes paid from the $600,000, and we take into consideration only the amount that we effectively will earn if we sell this land. Okay, these are examples that will explain, if you want, the difference between sunk and opportunity costs. Let's move to the estimation of the cash flows in relation with the project. As I said, in the analysis of the capital budgeting, we will not use the accounting revenues of the company, the accounting earnings like net income, earnings before interest and taxes, etc. Why? Because simply we will see it, some of the revenues and some of the charges, costs used when we compute the net income, the earnings of the company, are not made into cash effectively during the period. So we have to exclude them or include them again according to the item we are considering. We will explain this later. So here, how to compute the cash flow when we have an expansion project. Then we will move to the case of a replacement project. The cash flow for a conventional expansion project can be grouped into 4 components. We will see the details later. First, we need to estimate the initial outlays, the initial investment. We call it the investment outlays. Today, at the date 0, what is the cost of making this expansion project? Could be composed by different costs: the cost of buying the equipment, the shipment of the equipment, the installation of the equipment, etc. The change in net working capital. The net working capital is simply another amount, another investment required to finance the operating activity of the company and the increase in the activity of the company due to the use of this new product. We will see it later, the details of how to compute the net working capital, the meaning of the net working capital, and how to take it into consideration in our calculation. Then we need to compute the operating cash flow over the project's life. What will this project generate for us, for the company, during its life? How to estimate it? This is the first thing that we will do later. And we need to estimate eventually the terminal year after tax net salvage value, because sometimes at the end of the project's life we can sell some of the equipment at a salvage value. We call it salvage value, residual value. And we have to take into consideration the net salvage value, the salvage value after paying the taxes, eventually taxes on gain, if you have realized a capital gain. And we have to take into consideration this additional cash flow during the terminal year of the project. We will see the details of the calculation of these 4 components. We will start by the first one: how to compute the operating cash flows of the company, how to estimate the operating cash flow of the company. As we said, the analysis must be based on cash flows, not on net incomes. Why? Simply because we said one of the basic principles of capital budgeting is to separate the investment decision from the financing decision. It means that when you estimate the revenue that this new project, the choice, the implementation of the new project will generate for the company, you have to ignore, you have to not take into consideration the financial charges, mainly the interest rates, the interest charges, due to money that you borrowed to be able to finance this project. So we will not take into consideration the interest charges in the calculation of the cash flows of the revenues. Then these interest charges will be used later in the discount rate. We will see how to manage the discount rate to compute the value today of the future cash flows. The interest rates, the interest charges are excluded from the estimation of the cash flows. They are included later. We use them later when we compute the different criteria. We will see this in the third part of the chapter. So when we exclude the interest charges from the calculation of the net income, remember, when we compute the net income of a company, the income statement, we take the sales revenues, you subtract the operating costs, you subtract the depreciation and amortization, you get earnings before interest and taxes. We call them the operating income. Then in the income statement, the classic income statement, you have to subtract interest charges before computing the taxes. You put minus interest charges. But as I said here, for capital budgeting purpose, the cash flows, the calculation of the cash flows ignore the use, the subtracting the interest charges. So we do not subtract interest charges. We directly compute the taxes on the basis of earnings before interest and taxes. In the normal case, when you compute the net income, you compute the taxes on the basis of earnings before taxes. You subtract interest, then you compute the taxes. Here, no, we ignore the existence of interest charges. We subtract directly the taxes on the basis of the earnings before interest and taxes. It is equivalent to saying that the company is unlevered. The company has no debt. This is why we call the net income the unlevered net income in this case. When we ignore the existence of the interest charges of the debt, we call the net income the unlevered net income, or alternatively, the after-tax operating income. This is the operating income, earnings before taxes. Earnings before taxes times 1 minus the tax rate are called the after-tax operating income, or in finance we call them net operating profit after taxes. We have different ways of calling this metric if you want. Now, this is the first step. We compute the unlevered net income by not subtracting the interest charges when we compute the taxes. Then, in finance, we focus on cash flows, not on earnings. And since in the calculation of the earnings of this unlevered income, even in the calculation of this unlevered income, some of the revenues we have here in sales and some of the costs we have here, some of the revenues were not paid during the year or the period, and some of the charges were not paid in cash during the year. For example, the depreciation and amortization, which is simply something that we put in the books of the company to say that a portion of any investment made by the company, tangible investment or intangible investment, here we're talking about tangible investments, so depreciation only if you want. Some of the, each year we can, the government allow us to put, to take one portion of the investment made and subtracting it from your revenues, before computing the taxes that you have to pay to the government. It's a way of encouraging companies to make new investments. So any investment you make, each year you have the right to subtract a portion of the cost of the investment from your revenues before paying the taxes. So depreciation are tax deductible. Or the subtraction of the depreciation from the revenues will reduce the net income of the company or the unlevered net income of the company. But in reality, are the depreciation and amortization a cash charge? Will we effectively pay a check to someone else, to a third part of the company, in which we put depreciation and amortization of the year? Of course, no. We put it for financial and tax purposes, but effectively, the depreciation and amortization do not represent an outflow of money. It's not a cash outflow. So since we subtracted them, and since they reduce the unlevered income, we have to add them back to say that these amounts are subtracted from the net income, but in reality, they do not reduce the cash available because we do not have a cash outflow called depreciation. So we have to adjust to correct the unlevered income by adding back the depreciation and amortization subtracted to take into consideration effectively the available cash. So the available cash will be operating cash flow equal to the unlevered net income plus depreciation and amortization. I said that even in the sales revenues, we have some revenues that will not generate effectively a cash inflow. For example, the capitalized production. Capitalized production, when the company uses some of its production by itself. For example, company that produces computers, for example, can use some computers, تاخذهم البرودكشن بتاعها, and the company will use these computers by itself. Here we have to register these sales. We call them the capitalized production. But will these sales generate a cash inflow to the company? No, it will not generate a cash inflow to the company, so we have to subtract them. But in general, the value of the depreciation and amortization are by far the largest non-cash item. And in many cases, all other non-cash charges or revenues broadly net to zero can be neglected if you want. This is why, to simplify things, the operating cash flow of the company can be estimated by simply computing the unlevered net income, as I explained here, and simply adding back the depreciation and amortization of the year. You get your operating cash flow. Let's take an example here. As I said, should financing effects be included in cash flows? No, we do not include the financial charges in the calculation of the cash flows. The financial charges, the interest charges, will be taken into consideration later in the calculation of the criteria, another phase of the process. To compute the depreciation, we have mainly two ways. We can use the straight line depreciation, constant depreciation each year, or the modified accelerated cost recovery system. The modified accelerated cost recovery system will consist on getting different coefficient, unknown coefficient, that we will use to determine the annual depreciation. According to the property class, we can have 3-year depreciation, asset, 5 years, 7 years, 20 years, etc. We have different categories. So we simply multiply the equipment cost, if you want, by the rate, this coefficient, to get the depreciation of the. This will allow the company to recover more quickly, if you want, the cost of the equipment. We will see the implication of using the modified accelerated cost recovery system later in another application. Let's do this first application, assessment of operating cash flows. A firm intends to acquire a new machine costing $100,000 and having a useful life of 5 years. The revenues foreseen for the first year are $25,000, and we expect an annual increase of $3,000 in revenues annually. The operating expenses, excluding the depreciation, operating expenses are the fixed costs and the variable costs, if you want, for the first year are $3,000, with an expected annual increase of $1,500 for the following years annually. The company uses the straight line depreciation. It means that the depreciation will be annually the cost over the number of years, and the tax rate is 35%. We're asked to compute the expected operating cash flow for the 5 years. Simply, the operating cash flow is the sales minus the costs minus the depreciation. We subtract the costs, the taxes, then we add back the non-cash charge, the depreciation. The depreciation using the straight line technique is 1,000 over 5, 20,000. These are the revenues expected to be generated during the first year, 25,000. That will increase annually by 3,000. Operating expenses subtracted 3,000 first year, and these 3,000 will increase by 1,500 annually. We subtract the depreciation, 20,000 annually, you get the earnings before interest and taxes, the operating income of the company. Here, directly we subtract the taxes. Even if the exercise we have interest charges, we do not take into consideration interest charges. As I said, we do not take into consideration the financing aspect of the capital budgeting. We simply take into consideration the operating aspect. The financing, no, we do not subtract the interest charges. Directly we compute the taxes, 35% of the earnings before interest and taxes. Earnings before interest and taxes minus the taxes will give you the unlevered net income, also called after tax operating income or net operating profit after taxes. No tax, net operating profit after tax. We add back the depreciation, which were subtracted initially, but since they are non-cash charges, we have to add them back to the unlevered net income to get the operating cash flow annually. This is a basic example that shows how to compute the operating cash flow. Of course, we have many other details to take into consideration. We will see them, inshallah, during the next session, next week. Okay, I hope it is clear. Do you have questions, Yasmina?
Yes, sir, I have one question.